Welcome to Tony Byrne's View with news you can use. Tony has over 32 years of experience as a chartered financial planner and wealth manager. Tony's passion is to help you retire early and live the life of your dreams with no financial worries. Now to today's episode.
How to manage sequencing risk when taking income from your portfolio. Sequence of returns risk, or sequence risk, is the risk that an investor will experience negative portfolio returns very late in their working lives and or early in retirement. The risk of receiving lower or negative returns early in a period when withdrawals are made from an investment portfolio is known as sequence of return risk. If you're taking withdrawals from your portfolio, the order or the sequence of investment returns can significantly impact your portfolio's overall value. The 4% rule is a rule of thumb that suggests retirees can safely withdraw the amount equal to 4% of their savings during the year they retire and then adjust for inflation each subsequent year for 30 years. The 4% rule is a simple rule of thumb as opposed to a hard and fast rule for retirement income. So how to mitigate sequencing risk? 1. Build buffers into your portfolio so there's no need to sell during downturns. 2. Contribute larger amounts early on if possible. 3. Monitor returns. 4. Adjust asset allocations at appropriate times. 5. Adjust spending levels if required, if you are able to meet your income needs elsewhere. When the coronavirus pandemic emerged and stock markets fell in March 2020, I advised a number of clients to lower their attitude to investment risk and reduce their income withdrawals from their portfolios. Many clients followed my advice. This action resulted in greater preservation of their capital. Over the last 2 years, most clients have reverted to the previous higher levels of investment risk and restored their previous income withdrawal limits or levels. This has proven to be a successful approach because stock markets appear to be recovering over the last few weeks after 6 months of poor performance. Another favoured strategy is to phase investment over, say, 3 or 6 months by investing a third or a sixth of the money monthly in order to reduce the risk of investing all of your money just before a stock market crash. If the market does fall, then you're investing at an average price over the phasing time period. This is known as pound cost averaging. So the key to managing your sequencing risk is being flexible and open-minded about changing track in the short term if markets suddenly turn against you. That way you preserve your capital better. You know it makes sense.
Thank you for listening to today's episode. If you enjoyed it, don't forget to share it with your friends and family. For more information, head to www.wealthandtax.co.uk.